First, we start with global growth fears weighing on the minds of investors. Hedge fund manager Kyle Bass, just the latest to sound the alarm. Listen.
So it looks to us like Southeast Asia is headed for a recession in 2019. Europe's headed for a recession in 2019. And the U.S., the kind of fiscal impulse from our tax stimulus is going to be wearing off towards the end of 2019, where I think the U.S. will, the world's not going to have a recession and the U.S. keep growing. So I think you're going to see the U.S. have a minor pullback in 2020.
Are you betting on U.S. stocks?
I'm not. I think given the scenario that I just gave you, what I think is likely to happen is U.S. interest rates are going to head back to zero in 2020.
All righty then. So should Wall Street still be worried about a global slowdown, and is the best already in the stock market this year? Tim Seymour.
Well, I don't think Kyle Bass is a smart guy, a guy that likes to also be on the bearish side, at least as it's related to the global economy. And he's been talking about Asia for a long time. It's actually been right, but this is the point. Is it really a surprise to us that China's been contracting in terms of their PMIs? We've had a total raft of data, whether it's Singapore last night is 3 straight months sub 50, Taiwan, Korea the night before, we're at 3.5-year lows on their PMIs. I think we know this. Now, the question is how much of that is really just the confidence level that came out of the trade war? Certainly those most exposed to cyclicality. Certainly you could say that with Taiwan, with semiconductors, et cetera. This is where we are, though. I mean, if you think about this, 6 months ago, we were talking about the world overheating. We were talking about actually the Fed have to step in and be too hot. I don't think things have changed that dramatically. I realize the data has priced this in, but no, I don't think we're going to be at zero rates next year.
But let's be really clear. When we were worried about world overheating, it was really just the U.S. It was really just the course of our trajectory and the course of our rate increases, and it was not really the focus. In Europe, people were worried that they were taking QE off the table too quickly, and in Asia, we know that there's some just really systemic issues there. So I think the biggest takeaway from what Kyle Bass had to say there is that whole notion of decoupling. What he's saying is that if Asia is going to be headed into a recession, if Europe is already on its way to a recession, the notion that the U.S. is going to avoid that is probably slim to none. The one issue that I take right there is that he said he expects U.S. stock to have a mild pullback. Well, here's the thing. We had a 20% peak to trough decline in the Q4. We've given, we've made a lot of that back in just the first 2 months of the year or so. I think the chances, whatever you think mild is, I mean, the chances of a retest of the low, if we have Asia and Europe in recession in the back half of this year, is very high.
So I'm curious, though. We talked about 0% interest rates. I mean, I don't really see that happening. It could, absolutely could. Does that mean there's a put in the market, though? There was a Fed put for a long time when interest rates are zero.
I mean, isn't that the reason? Isn't that the principal reason that we went from Christmas to where we are now? Because of a belief that Powell had your back, so to speak, yet again?
I think it was that he stopped pressing on your neck as opposed to having your back. I don't know, just to pick a slightly different metaphor. But for a long time, remember the Tepper rally was all predicated on zero interest rates.
David, with all due respect.
Yeah, not me. It's okay.
Oh, right.
Smart Tepper.
So I don't know. I don't know if that means then that is there another put there? I don't think we're going to see the zero interest rates this year, but we could.
Zero interest rates? I mean, I think that, look, again, I think zero interest rates is a concept that he's talking about, because we're not going to zero interest rates. At the lows before the elections, we were 136 in the summer of 2016. We're not going to zero. And in fact, how about the U.S. deficit that we're running? Do you think people want to buy our debt in a slowing economy? You think the 10-year is going to go to 136 again? I don't think so. How about copper that's trading at $3? It's basically at 18-month highs. How about oil that's at $65? These aren't telling me that the world is going out of business.
No, part of the implication, part of the implication Bass makes is that the Fed's next move is a cut, if not more than one, because of, as Dan said, the idea that you could decouple yourself just falls through the floor.
Yeah, I mean, I think Janet Yellen even said the same thing, that the Fed's next move could be a cut. I don't see that happening anytime soon. I don't think economic data in the U.S. is that bad. It's definitely deteriorating. It's not great, but at the same point in time, economic data is not bad. All we really need is we need another positive catalyst right now for U.S. stocks. I mean, the Fed is on the sideline. Check.
What's that going to be
growth.
then? What's that going to be? What's that catalyst going to be?
We need a
I think
trade
a trade deal,
and we need earnings growth to resume. I mean, right now, forward expectations and guidance, everything is so low, but that means the hurdles are low. So, once we get a trade deal done and earnings growth can actually resume, I think the market is going to go higher.
You don't think that's already in the market, that this notion that you're going to get a trade deal? People have already started to
I think it's mostly in the market. I do. But one thing about that, though, if we do get a trade deal, Kyle Bass talking about problems, slowdown in Asia, they're going to be just as much, if not more, a beneficiary than we. So I could see the convergence being from their economies improving.
I think you're actually going to see a rebound in China, personally. I mean,
Well, they're going to stimulate the...
They are.
Yeah,
It's like
they are stimulating
there, right? Fiscal, monetary, credit. So, I mean, there's certainly an opportunity for China to rebound. And when that demand from China rebounds, that's going to help the other international economies as well. So, I'm not as pessimistic on China.
I still feel like, though, this is, Dan, a now what market, right? Yeah, this big move. There's optimism about trade. Now, maybe some of that today is a little more tempered. The economy's not great. So what gets you to that
So let's
next
talk about
leg?
the trade deal. Okay, so let's say, what have we heard out of China so far is they're going to buy more of our stuff, okay? Well, what's been our stuff that actually had these tariffs? They've been going to other, they've been filled in other locales, right? So when you think about it, we're just kind of pushing from one point to the next. If we don't have global growth, China just told us overnight that 6.6% growth last year is going to be between 6 and 6.5. Our friend Peter Bookvar says, don't look at that number. Actually, just look at the trajectory, because that's where it's been going for about 10 years or so. So if you don't have China growing, even if you have a trade deal, even if we are able for them to buy more of our stuff, it's going to be coming away from some other place where they were buying it before. So to me, I'm just saying that if you have Europe just stagnating and you have Asia just really dealing with a lot of excess, the likelihood that the U.S. is going to pull us out, the globe out, is just not very likely.
There's no Pollyanna view here. A lot of bad stuff can happen. There's a lot of risks out there. But we've crossed the Fed off the list. We've said trade deal. Think about what the trade deal did. It basically took global synchronized recovery 1 year ago and took confidence out of the market, which meant CapEx spending was off the table. It meant business confidence was off the table. And that's around the world. I'm not saying that reverses immediately, but to say that a solution to that, and to be clear, what is this trade deal? This trade deal leaves us exactly back where we were. Chinese are getting what they want. The administration is probably getting what they want. I'm not sure we're getting what we want, which is protection of IP and technology and control of the internet for the 21st century. We're not going to solve that.
You think the market cares about the deal itself as long as it just gets a deal? You think the market cares about the quality of the deal?
No, I don't.
Well, think of Scott, go back to December of 2017. We had this tax cut. We had this huge rip from mid-December into the highs in January 26, 2018. What happened after that? We literally dropped 10% in the next 3 weeks. And then we spent the rest of 2018 really churning, right? And then once we got back to those prior highs, we dropped 20%. So if you take out some of the extreme movement, there's a really strong likelihood that since that tax cut, all that fiscal stimulus, which was supposed to be the massive catalyst, we've been going sideways for about a year and a half now.
But what was that sideways about? It was absolutely about the Fed, and it was absolutely about trade. So Jan 26, 2018 is when markets peaked. EM has a blow-off top. Sentiment and positioning was so overly ebullient. So, to me, again, I don't know that we have to replace that. And I would agree, like everybody here, we're late cycle. We're seeing slowing growth. Earnings are hardly impressive. But to tell me that it's falling off a cliff so dramatically, I think Europe's data for the short run has actually bottomed, and I think China's data for the short run is absolutely bottomed.
There's going to be a view as well, and there already is, really, that earnings are going to trough here in the first quarter. If you get a trade deal, you get better corporate outlook, sentiment rises, earnings estimates go up, guidance is lifted, earnings are better, stocks rise. It's
virtuous. It's a virtuous thing. And I think don't discount the Fed. I think everyone here would probably also say, I certainly believe that the Fed could be not that far away from stepping back into a hawkish tone. And that's the biggest fear I have.